So friends, myself RP Bhardwaj, convener of NAGAR KESHAV CP Study Circle, welcome all the participants in today's seminar. Today we are in the discussion of this refresher course on NDS. It is the last topic today. We have already taken 4 sessions in this series of events. Today we are going to discuss two very important NDSs, Ind AS 116 on leases and Ind AS 12 on income tax. The guest speaker for today's discussion is CA NILESH KHEMKA ji. I welcome CA NILESH KHEMKA in our study circle. Before inviting him to start his deliberation, I request our founder convener RK Gupta ji to kindly briefly introduce the speaker and start the proceedings. Over to RK Gupta ji.
Thank you, CA RP Bhardwaj ji, and welcome NILESH KHEMKA ji to our study circle. Regarding NILESH KHEMKA ji, he is a chartered accountant by profession, and he has significant experience in IFRS domain, having worked on gap conversion projects for multiple clients in oil and gas sector, banking sector, auto sector, and real estate sector. He has been a core member on various process improvement projects, accrual simplification, and financial reporting engagements. He has been involved in engagements that include identifying opportunities for change, financial reporting procedures, analyzing data flow among various systems, and preparing budgets and allocation reconciliations. NILESH has experience in automating input templates and MIS reports for senior stakeholders. He has good experience in delivering result-oriented process transformations, reducing the processing time for transactions, carrying process reviews, and ensuring smooth transition of BAU activities. Financial reporting advisory services with respect to gap conversion, revenue assurance, accounting due diligence, advising on technical accounting, change accounting matters, implementation of IFRS, Ind AS. So with this illustrious background, we have with us CA NILESH KHEMKA ji, who will be guiding us on Ind AS regarding leases and taxes. So it is all yours now, NILESH KHEMKA ji.
Thank you, Gupta ji. Thank you, Bhardwaj ji, for inviting me to this CP Study Circle seminar. So let me just share my screen.
Bhardwaj ji, you have made him co-host?
Yes.
So you can share your screen, sir.
Yeah. So Gupta ji, my screen is visible?
Yes, now it is visible.
Okay. So
but you are on mute, sir. NILESH KHEMKA ji, please. Yes, now unmuted. Yes.
the second topic is Ind AS 12, which is on income taxes, which covers deferred tax as well. So first of all, we will do Ind AS 116 leases, and the second topic we will cover Ind AS 12. Giving a brief background about the introduction of Ind AS 116 on leases is the major change from the previous standard under Ind AS, which was Ind AS 17. The primarily difference is there is a removal of difference in operating and finance leases from the perspective of lessees. So in the erstwhile standard, there were two categorization of leases. One was operating leases, one was finance lease. So there were some 5 to 8 conditions, and if any of the lease agreement was satisfying these 5 or 8 conditions, the lease agreement was considered as finance lease, and the accounting was as governed by finance lease captions. Otherwise, all the agreements were regarded as operating leases. Now, Ind AS 116 does not categorize any lease agreement from the perspective of lessees into operating or finance lease, right? All the leases are operating leases. Second major change is in the erstwhile standard, we used to recognize rent expense on a straight line basis in case of operating leases, right, in the P&L account. Now what has happened is all the leases will be shown on the balance sheet of the lessees on the asset side, we will have right to use asset. On the liability side, we will have lease obligations, or let's say lease liabilities. Regarding the P&L impact, we will have interest expense while we unwind the lease liability, and we will have depreciation expense for ROU asset, right? Now, how to calculate ROU asset and how to arrive at the figure of lease liability, we will see in the later slides, right? So let us start this conversations. First of all, we need to see what all arrangements are scoped out of Ind AS 116. There are some of the agreements or let's say lease arrangements which are not covered by Ind AS 116. Then there are some key concepts regarding what is the definition of lease, which type of contracts are covered under this standard, right? Then what is the accounting from the perspective of lessee, which has got substantially changed under this standard. If we compare this with Ind AS 17, that was the erstwhile standard for leases under Ind AS. Then fourth is the lesser accounting under Ind AS 116. This I would say there is no change in lessers accounting under Ind AS 17. It was same under Ind AS 116. It is exactly same. So there is no change for this from this perspective. And fifth one is the disclosure requirements, presentation and disclosure requirements while we prepare our financial statements under Ind AS. So scope part says this standard is applicable to all type of lease arrangements. However, following 5 are the exceptions. So this Ind AS 116 is not applicable in case of lease arrangements to explore mines and minerals or natural gas or oils, because we have a specific standard, that is Ind AS 106 for this purpose. Second scope exemption is any lease arrangement for biological assets. Again, we have a specific arrangement Ind AS 41. Third is service concession agreements, where government gives the license to, or I would say permission to construct the infrastructure. Let's say road. NHAI has given permission, let's say, to Reliance Infra to construct a particular road and operate it, right? So these type of arrangements are considered as service concession agreement, and again, these are out of the scope of Ind AS 116 because these are governed by Ind AS 115 Appendix C or D, right? Then any arrangement for intellectual property rights, again governed by Ind AS 115. Any rights held by lessee for motion pictures or video recordings or manuscripts, patents, copyrights, these are also covered by another standard which is Ind AS 38. So apart from these 5 type of lease arrangement, all the lease arrangements are within the scope of Ind AS 116, provided that particular lease agreement or arrangement is fulfilling the condition or let's say definition of lease which is specified under Ind AS 116. Now, what is the lease definition? It says a contract is or contains a lease. That means the lease contract or lease arrangement will be regarded within the scope of this standard if that particular contract conveys right to control the use of asset, right? So it says right to control the use of identified asset. I am breaking this line into 2 parts. One is right to control the use of asset. Second is that asset should be identified within that lease agreement, right? If both these conditions are not satisfied, then this arrangement or lease agreement is not within the scope of Ind AS 116, and we will not do the accounting as per Ind AS 116, but we need to go through other standards, right? Now there are 2 conditions. I said I will break this line into 2 parts. One is identified asset. Second is right to control the use of that identified asset. Now what is identified asset? So standard says any asset that is explicitly or implicitly identified, right, in the contract or when we are entering into the contract, that is at the inception of the lease. Second is lesser. or the party from whom we have taken any asset on lease, lessor do not have any right or substantive right to substitute that asset, right? Take an example of photocopier machine. Large companies take photocopier machines on lease, right? Now, in general, a company would say to the vendor, I would require 100 photocopier machine, right? Now, take a scenario where on a particular day, let's say 10 machines or 10 photocopier machines runs out of the order, right? Now, if the lessor has right to substitute these 10 machines, right, for any other version or any other make or type or model, let's say the 100 machines given were of HP model. Now, when these 10 machines run out of order, the lessor provided the 10 replacement machines from the Canon company, right? So this shows like this lessor has the right to substitute the asset, right? In this case, it is regarded that asset is not identified in that particular contract. Whereas if in the contract it is mentioned we need 100 photocopier machine, then it is also mentioned how many should be black and white, how many should be colored photocopier machine. After that, it is also mentioned the photocopier machine should be from which manufacturer, what should be the model number, right? What should be the make and type. If all of these are specified in that particular contract, that makes it mandatory, or let's say that makes it not providing any right to the lessor to substitute that asset. Because if in any case any of the machine runs out of the order, then that lessor has to provide exactly same make and type and model as an replacement machine, right? Other condition is explicitly or implicitly specified. This means when we are entering into the contract, either that particular asset is written in the contract that we need HP 1001 photocopier machine colored make and type, let's say 2015, right? Or if it is not written in the contract, then it is specified at the time of entering into the contract, maybe oral or verbal, but that has to be prior to that asset has to be identified prior to entering into the contract. If both these conditions are satisfied, then we can say yes, the asset is identified for the purpose of this particular lease arrangement. Second example could be PSUs take the vehicles on hire, right? If let's say ONGC has taken 100 cars, if the contract is simple, we need 100 cars, or let's say 100 cars with capacity of 4 persons to sit. It's an open contract. Lessor has right to substitute any car at any given point of time, right? But if the conditions are specified, we need only Honda City cars. Car should be let's say white, right? And model, let's say 2020 model, or let's say 2018 models, right? And the numbers of these 100 cars are also specified in the contract, then lessor don't have any substantive right to substitute the asset, right? Or to substitute the car. But if the registration number are not specified in the contract, the only condition is 100 white Honda City car with 2020 model. There could be n number of cars company has manufactured, so lessor can make available 100 cars at any given point in time. But as soon as company writes the registration number as well for these 100 cars, then it's binding on the lessor to not substitute these car, right? It is the responsibility of the lessor to make sure these 100 cars are in working condition at any given point in time on a working days. So this shows the lessor do not have any substantive right to substitute any of these car for other cars, right? Now, second part of the statement is customer has right to control the use. Now, what would customer control? It should control what type of product will be manufactured or how that particular asset will be used, right? That means all the economic benefit from using that asset, which we have taken on a lease, right, should flow to the lessee, right? when we say substantially all economic benefit, that means 100% output should be flowing to the lessee only. There should not be any quantum flow to any other entity, right? Let's say there are joint products, main product and byproducts. So both joint product and byproduct should flow to the entity. Second is right to direct the use. If I have taken any machinery on hire, so right on how this machinery would be used, whether it will be used in-house, whether it will be used, let's say, outside the factory gate, who will operate, how the one will operate, when this machinery will be used. So WH question, answer to this WH question should lie with lessee only. That means lessee has the right to direct the use of that particular asset, right? So for the identified asset, it says contract contains a lease if it relates to an identified asset, right? This slide is what we have discussed till now. Then asset can be either explicitly specified. We can just mention 100 Hota City car with the make and model and along with the registration number, or implicitly specified at the time it is made available for use by the lessee. That means when we are entering into the contract at the inception of the lease agreement, we can implicitly specify it, right? Another example for this is, let's say Cafe Coffee Day approaches to the Airport Authority of India in Delhi to get some space for installing its outlet for coffee vending machine. Now, if Airport Authority says you can earmark that space towards the right and measuring, let's say 10 by 10. So we are not writing this particular space in the lease agreement, but that has been implicitly specified when we are entering into the contract. So it is also an identified asset. But if Airport Authority of India says we have this square space available of, let's say, 500 square yards, you can choose any space. In this case, the space is not identified for that particular purpose, or we do not have identified asset in this second case, right? Now, second is what are substantive substitution right? It means an asset is not identified if lessor has right to substitute the asset, right? That means we are not identifying the asset in the lease agreement, or we have given a right to the lessor. In order to provide seamless service, he can change the asset with other assets also. That means the lessor has right to substitute these assets. So standard says we will regard this not to be considered a lease agreement under Ind AS 116 if you have given the lessor this right to substitute the asset. Lessor substitution right is substantive if the lessor has practical ability to substitute the asset. When will this practical ability will come? When we have given him right or the assets are not identified in the particular lease contract, and lessor would benefit from exercising its right. Now standard says whether the rights are substantive or not, we need to evaluate at the inception of the lease only, not after entering into lease. Because if we are not evaluating this right at the inception of lease, we may end up in wrongly accounting these lease agreements. Now, right to economic benefit, as we have seen, standard says all the economic benefit from the use of that asset should flow to the lessee only, right? So it says to control the use of identified asset, customer must have right to obtain substantially all of the economic benefit from use of the asset throughout the period of use. Economic benefit may be either I am using that machine, either I have given or sublet that machine, or I am holding that machine, right? So it can be in any case. Either I can use to manufacture any product, or I can give it to other manufacturers to use in their manufacturing process, and I can get rent in return, right? So economic benefits can be anything. Economic benefits include primary and byproducts as well, right? When assessing customer right to obtain substantially all the economic benefit from the use of the asset, entity considers economic benefit that result from the use of the asset within the scope of the customer's right, right? So I have taken a machine. Now, whatever boundaries are mentioned in the lease agreement within which I can use this machinery, right? There are some restrictions which lesser can apply, right? What type of product I can manufacture, or let's say I cannot manufacture XYZ, or I cannot use XYZ type of material from that particular machinery, otherwise that machinery may get a breakdown, right? So we need to consider these boundaries or these conditions as well, and within these conditions whatever output is produced, that should belong to lessee, because there are various machineries which are capable of producing multiple products, right? So the products for which I have got in agreement with the lessor, that should only be considered for the purpose of this condition, for substantially economic benefit. Now, right to direct the use of that particular asset, or let's say identified asset. As I mentioned in the first slide, the one who takes the decision regarding the WH question, these are WH question, will be regarded the one who is controlling or who is who has right to direct the use. The- so if the agreement says lessee will take the decisions regarding what type of output is produced or what type of product is produced, when it is produced, where, and in what quantity. So in order to in order to facilitate that particular lease agreement under India's 116, all these type of questions or all these type of rights should rest with the lessee only. If lessor has any say in any of these type of conditions or in any of these type of rights, then this may end up not being classified as lease agreement under India's 116. So any question till this slide?
If any of the members have any question or any query, you can unmute and ask, or you can also write in the chat box. Our guest speaker is available for answering your queries. If you have any query, you can unmute yourself or write in the chat box. Both the options are available. Nilesh, kindly move ahead. It appears there is no query.
Sure. So there are couple of case studies on the concept which we have just now discussed. So first is, let's say there is a contract entered between the customer and a freight carrier, right? To provide customer with the use of 10 rail cars of a particular type. So here it is mentioned the rail cars should be of a particular type. This is mentioned in the lease agreement, or let's say in the requirement. Period is 5 years. It is also discussed or agreed lessor cannot provide alternative rail cars. This means the asset is identified in the contract. Lessor do not have any substantive substitution right, because we need only the 10 rail cars of this particular type, which may be specified in the contract. Right to economic benefit, yes. Right to direct the use, customer has right to direct the use, when and where these rail cars will be used, how and for what purpose, right? So this is a lease arrangement under India's 116. Now, second question is, or second case study is, coffee company enters into a contract with the airport operator, Airport Authority of India, to use space in the airport to sell its goods for a period of 3 years, right? So they have not identified any space, right? So asset is not identified because many areas are available, right? But if here the, let's say the direction is mentioned, Airport Authority has given an area of 10 by 10 towards the right at the top, then we can say it is an identified asset. Lesser has substitution right, yes. Airport Authority has substitution right because asset is not identified in the contract. Right to economic benefit will be with the lessee only or the coffee company. Right to direct the use, no. Supplier, it is the supplier or the airport authority which decide which space has to be given. So in that case, right to direct the use of that space is not lying with the coffee company but with the airport authority. So in that case, this particular contract is out of the scope of this standard. That is, Ind AS 116 does not cover this particular lease agreement. So this graph is a gist of all the conditions which we have just now discussed. These are yes or no. If you start with this and if you answer all of these queries, you will ultimately be getting an answer whether the contract is or contains lease as per Ind AS 116 or it is out of the scope of this standard. Now there are some key concepts under Ind AS 116 which are like the certain practical expedients related to low value assets or short term leases, then how to determine lease term, how to determine lease rent, or how to calculate lease liabilities, and the separating non-lease components. So we have often seen arrangements when we take, let's say, commercial space or residential space on a rent, we need to also pay the service charge, right? Or maintenance charge. So these type of charges are regarded as non-lease components. So standard says while we account for these type of lease arrangement, we need to separate the lease and non-lease components. However, standard has also given one practical expedient wherein lessees can make a like a accounting policy choice, right, of not separating these non-lease component, right? So India 16 not applicable on the service component, right? Many contract contains a lease coupled with an arrangement to purchase or sell the good, like security services, maintenance charges, other service charges, right? Non-lease components are identified and accounted for separately at the inception of the lease under Ind AS. For example, there is a lessee who enters into a 3-year lease of equipment with fixed annual payment of 12,000. Now the breakup of 12,000 is 9,000 towards rent, 3,000 towards maintenance. Determine the lease and non-lease component. So lease component is the rent towards the equipment, that is 9,000, right? Total consideration in the contract of 36,000 will be allocated to lease component and non-lease component maintenance, right? So we are paying 12,000, right? And it is a period of 3 years. So 36,000 we are paying. Out of the 36,000, 3 into 3, 9,000 belongs to this non-lease component and rest belong to rent. But again, company has a accounting policy choice, or let's say practical expedient. As per this, company can make accounting policy choice of not separating these lease and non-lease component, and they can consider this 12,000 as the lease rent and do the accounting under Ind AS 116. If company wants to separate non-lease component, they can do so. They can charge off this 3,000 into the profit and loss account and apply Ind AS 116 on this 9,000. So it's up to management or the company whether they want to follow this practical expedient or not. Second key concept is lease term. Again, it's a very critical term or critical assessment because when we calculate the lease liability, lease term is very important. If we are not calculating the lease term correctly, we may end up calculating the wrong amounts of lease liability and ROU asset. Right. So it says lease term can be defined as the non-cancelable period. Non-cancelable period means the period during which the agreement cannot be cancelled by any of the party. If either of the party cancels, then they need to pay the penalty or termination charges to other party. So first of all, this is a non-cancelable period plus any extension option, right? That will be included if less is certain to exercise that option. Then any termination option if less is reasonably certain not to exercise that option. So if we want to understand this with the help of example, let's say there is a lease of 10 years and the initial 3 years are non-cancelable. Neither lessee nor lessor can cancel the lease agreement. So in this case, or as per the guidance, that 10-year will not be my lease term, but my lease term will be 3 years only, right? But we have seen in the India 17, we were considering this 10 years as the lease term by default, right? So under India 1116, we need to carefully read the agreement and then calculate the lease term, right? Now imagine after this there is a condition after the initial 10 years, lessee has the right to extend this lease term for, let's say, 5 years more, right? And on the initial date we are certain lessee will opt this option. So in this case our lease term will be 3 years of non-cancelable period plus 5 years of extension option. So our lease term will become 8 years. If we were following India 17, then our lease term would have been 10 years only. We were not considering, or standard does not required at that time to consider this extension option, right? If there is an option to terminate the lease, right, we need to include that as well, provided lessee is not, or we know lessee is not expected to exercise that option, right? So within this, after, let's say, 3 years of non-cancelable period, there is a termination option after, let's say, 8 years, right? And we know lessee will not opt this case, so that remaining 2 years will also be added to the lease term. If we know lessee may exercise that termination option, then we need to exclude that part from the lease term calculation. So it is not very straightforward to calculate the lease term, to look in the agreement, search for the lease period, and consider this as a lease term. We need to read all the clauses with respect to lease terms, or let's say extension option, or purchase option, or termination option, and based on that, lease term has to be calculated. Second is some of the agreements start, let's say, from 1st April, but initial period of 3 years is given as a rent-free period, right? And rent payment only start from, let's say, 1st July. So under India 17, what we were doing is, when we were calculating the straight line of when we were doing straight lining, we were considering the 9 months, right? But India 116 says our lease period includes any rent-free period. So if I am paying rent for 9 months in a particular financial year, but my lease term will be 12 months starting from 1st April, because it includes your rent-free period. The impact would be, when we will discount the future lease payments, the impact would come in the discounting. So any question in these two concepts? Okay. Now third is lessee accounting. As I said, under India's 1116, all the leases, or it is said it's a single balance sheet approach model, wherein all the leases come to the balance sheet of the lessee, whether it is operating or financing, right? Operating or financing as per India 17, because now there is no categorization of leases into operating and financing under India's 116 from the perspective of lessees only. For lessor, we have the same accounting. So in the balance sheet, we will have, on the asset side, right of use. On the liability side, we will have lease liabilities. In the profit and loss, we will have depreciation and interest. There are two optional exemption for low value assets and short term leases. If we remember, there was an low value, there is a line, or I would say there is an accounting policy in most of the companies under Indian GAAP. Assets valued less than 5,000, or let's say any threshold, were considered to be in profit and loss account, and we were not capitalizing, right? So this is that sort of things only. Lessees can make an accounting policy choice, or let's say accounting policy, to not apply India's 1116 to the lease arrangements of certain threshold. If, let's say, there is an agreement for 6,000 per month, that is very immaterial for, let's say, Reliance or Tata's or any sort of company. So they can consider this opting this low value asset optional exemption. This is not mandatory. This is an optional exemption, and can be opted on a lease by lease basis. So we can opt for certain leases, may not opt for certain leases, right? Second is short-term leases. If, let's say, the company has entered into a lease arrangement which is less than 12 months, right? Then the company can opt for this optional exemption as well, but it has to be on a class by class basis. What does that mean? If, let's say, I have entered into short-term leases for furniture, so all the short-term leases for furniture has to be followed by this optional exemption. I cannot cherry pick the lease agreement for furnitures. For other classes, I have the option not to opt for this optional exemption, but for the furnitures, all the short-term leases has to be as per this optional exemption. If I am opting for one, I need to opt for others as well. This low value assets, this is available on a cherry picking basis. I can opt for certain leases. I may decide not to opt for certain leases, right? One condition in short-term leases is this: if I have entered into, let's say, a 10-month leases, but I have option to extend it further for, let's say, 4 months. In that case, this is not available because total period will become 14 months, which is more than 12 months. So it says if in case of low value asset, there is an extension option, and including the extension option, the period of lease becomes more than 12 months. Then it will not be considered as short-term leases, but it will be more than 1 month, and hence long-term leases, the optional exemption would not be available in that case. Again, case study, it says there is an entity that has leased several items of office equipment, some for less than 12 months and some for longer than 12 months, with none containing purchase option. Items of office and equipment are all considered to be of same class. So here, office equipment is my class of asset. I have many leases, some for 12 months, some for less than 12 months. So it says entity can choose short-term lease exemption provided it is opting for all the lease terms with 12 months or less, right? All of the leases with terms of 12 months or less. It cannot opt for certain lease terms or lease arrangement with 12 months or less, but all the lease agreement where lease terms is 12 months or less. Second is lessee enters into a lease where 9 months non-cancelable term with an option to extend the lease. So this 9 plus 4 become 13. Again, it is more than 12 months. So this short-term exemption is not available, because standard says if there is any option to extend the lease agreement, right, then we need to compare the total of the period with the 12 months. So any question till now? Okay. Now this is the main part of the standard. How do we calculate lease liability or initial measurement of lease liability? Initial measurement of lease liability means when we are entering into the contract, or let's say we have entered into the contract. Now we are supposed to do the accounting for that particular lease arrangement. So how do we calculate the lease liability? Calculate lease payments. First is fixed payments, which we will be making on a monthly basis, less any incentive if we have received. Incentive means rent free period
Nilesh ji, can you hear me? नीलेश जी, आप हैं ऑनलाइन? आपकी आवाज नहीं आ रही सर, देयर इज सम इशू. नीलेश जी, नंबर 1. नीलेश जी, आप लॉग आउट हो गए क्या? आप लॉग आउट हो गए? आपकी आवाज और फोटो दोनों गायब होगी, सिर्फ स्क्रीन खुली हुई है. हाँ, एक बार देखिएगा प्लीज.
हेलो,
जी जी जी,
आ रही है सर आवाज?
आप ठीक है.
अच्छा,
फोटो अभी नहीं दिख रही सर.
फोटो नहीं दिख रही सर इसका.
कैमरा
तो
ऑफ है?
एक सेकंड. नहीं नहीं, कैमरा तो ऑन है सर.
एनके के नाम से जो लॉगिन किया वो आपका ही है ना?
हाँ जी, हाँ जी.
बट अभी कुछ हुआ है
नहीं, मेरा
रिसेंटली? पहले फोटो भी आ रही थी, आवाज भी आ रही थी, 2 मिनट पहले गायब हुई.
अच्छा, तो एक बार दोबारा लॉग इन करूँ क्या, लॉग आउट करके?
दोबारा कर लीजिए, कोई नहीं, मैं हूँ साथ में.
एक सेकंड. अब आ गई
हाँ,
सर?
आ गई, आ गई सर, आ गई.
हाँ,
यस,
वो शायद कुछ.
अब ठीक है. नाउ
हाँ,
नाउ वी कैन प्रोसीड,
ओके
प्लीज.
ओके. हाँ. So if we were on the payments for any penalties for terminating the lease agreement, if lessee has terminated the lease agreement prior to the completion of non-cancelable period, or then that has to be considered as the part of lease payments. Any purchase option, if lessee is certain to opt for the purchase option, then any price to be paid shall also be included in the lease payment. Any residual value guarantee, that means let's say we have taken any machinery on rent for let's say 10 years, and lessee has guaranteed that after 10 years the fair value for this particular machinery will be let's say 1 lakh. So that also needs to be considered in the lease payment. If there are any deposits we have paid to lessor as part of lease arrangement, these are not to be included in the lease payments. We will do separate accounting under Ind AS 109 for these. So lease payments in principle includes 5 things: fixed payments, less any incentive, plus variable lease payment, any penalties which lessees will be paying for terminating the lease before the non-cancelable period is over, any purchase option price if lessee is certain to opt for the purchase option, and any residual value guarantees which is guaranteed by a lessee to lessor, and it is expected that that value will not be met at the time of the lease agreement is over. So we can understood this with the help of this example. So there is a company ABC which leases a production line from one company. The lease payments depend on the number of hours or operating hours for the production line. Let's say if this machine will work for 500 operating hours, then we need to give the amount as per this 500 hours only. The rate is 1000 per hour. So if 500 hours are used, then 500 into 1000. I think 5 lakhs, right? However, the annual minimum payment is fixed. Now it says annually minimum amount to be paid is 10 lakh, right? If it reaches over and above, then that has to be paid. So it means 10 lakh is the in substance fixed amount, right? The expected usage per year is 1500 hours. So the annual operating expense will be 1500 into 1000, that is 15 lakhs, right? So payment of 10 lakh is in substance fixed payment, and this will be considered as part of the lease payment, right? Because if you see, it says fixed payment including in substance fixed payment, right? So lease payment is 10 lakh. Additional 5 lakh, this is a variable amount which will vary based on the number of operating hours, right? Now this additional 5 lakh does not depend on any index or rate, but this depends on the number of hours the production line is used, right? So accordingly, this will not be included in the lease payments. This will be straightforward charge to the profit and loss account. It says additional 5 lakh that ABC expect to pay are variable payment that do not depend upon index or rate. Accordingly, these are not part of lease payments. Since the payment is not dependent on an index, hence not to be included in the lease liability and will be charged to profit and loss account as and when this amount is paid or incurred. Variable lease payment not depending on index. Company ABC leases a store. The lease payments for the store amounts to 1% of the store's revenue. Again, the lease payment is not a substance or not a fixed payment, not in substance fixed payment, not depends on any index or rate, right? Accordingly, there is no minimum rental payment. Any amount which is paid under this agreement will be straightly charged to profit and loss account. Third is variable lease payment depending on index. Company ABC rents an office building. The initial annual rental payment is 25 lakhs. The rent will be reviewed every year and increased by the change in the CPI index, right? So any increase which is as per the CPI index will be regarded as the variable lease payment. Accordingly, the annual lease payment is dependent on the CPI index, therefore to be included in the lease liability. Lessees generally recognize change to index and rate based variable lease payment as an adjustment to the right of use asset and in the period of any change. So any change in the lease payments. So initially this will be regarded as 25 lakh. We will do all the calculations based on the 25 lakhs. The year in which the amount will change based on this index, we will do the true up adjustment in that particular financial year. Now this is the example on residual value guarantee. Lessee has entered into a lease with lessor to lease a car. The lease term is 5 years. Lessee also agrees on a residual value guarantee. If the fair value of the car at the end of the lease term is below 400, then Z will pay to the L or lessor an amount equal to the difference. So at the inception of the lease, Z expects that fair value of the car at the end of lease term will be 300. So difference between the residual value guarantee and the actual fair value is 100. So this 100 will be included in the lease term or sorry, lease payments. It says 100 will be included as part of the lease payments. That was all for lease liability. Anything to be discussed in this or any doubt on lease liability part? Okay. Now ROU, how do we calculate ROU? So India 16 says whether when you have calculated lease liability, the ROU should be exactly similar to lease liability with these 4 or 3 adjustments. So let's say we have calculated the lease liability as 100 rupees. So I will start with the ROU of 100 rupees plus any initial direct cost. That means if I have incurred any direct cost related to setting up that machinery, right? Any transportation cost or any leasehold improvement due to that machinery only, I will include that as part of ROU asset. If there are any dismantling cost or site restoration cost to be incurred at the end of the lease period, that has to be included as the part of ROU cost. Plus, if there are any lease rent which we have already paid, that means if in my liability side I am showing any outstanding rent or or any prepaid rent in the asset side, then both these things has to be adjusted from the ROU asset. If there are any prepaid rent, that will be included in the ROU asset and we will deduct this from the prepaid rent. So that's a classification change. In the same way, if there is any outstanding rent in the liability side, we will decrease our ROU asset and we will eliminate the outstanding rent. Again, this is a classification change from asset to asset or liability to asset. But P&L neutral. There is no effect on the P&L for this particular change. If we have received any lease incentive, let's say we have incurred some initial direct cost in the form of, let's say, leasehold improvement or transportation or something else, and we have got this reimbursed from the lessor, then we will deduct this lease incentive from here, right? And accordingly we will arrive at the ROU asset, right of use asset, that we will be capitalizing in the financial assets under non-current assets, right? So this is an example. It says after initial recognition the lease liability is increased. No, sorry. So it's an example. Lessee X has entered into a contract with lessor to lease a building for 7 years. So it's a lease of 7 years. Annual lease payments are 450, which are payable at the end of each year. Borrowing rate is 5.04. We need to calculate the value of lease liability. Now, this is how we will calculate the lease liability. This is starting from, let's say, 1st April 19, right? So I will make first payment at 31st March 20 because it says at the end of each year. So 20, 21, 22, 23, 24, 25, 26. I have made 7 payments of 450 each, right? My total is 3150. Now we need to calculate the present value. This is how we calculate the present value. 7 years, borrowing rate is 5.04. Right? Present value comes to 2600. So first of all, we will do the accounting entry. We will capitalize ROU asset with 2600, and correspondingly there will be a lease liability of 2600. Give me some time. Half an hour. 5 minutes. Okay. And this is how the depreciation expense will be allocated. This is lease period is 7 years. So we will amortize or depreciate this ROU asset based on the 7 years period. So my depreciation is neutral. So this asset will be depreciated over a period of 7 years, right? I will be passing this entry for 371 every year, depreciation to accumulated depreciation, right? Now comes to interest. Now this 2600 present value, right? I will be making a payment of 450 yearly, right? I need to charge interest on this 2600 based on the IRR of 5.04, which is specified in the contract, right? So in the first year, the lease liability is 2600. My interest would be 131. I will make a payment of 450. My closing balance is 2281. This will be my opening balance. Again, I will charge interest at the rate of 5.04. These are the payments which is fixed in the lease agreements. If you see 450 annually, right? So I will be making a payment of 450 annually, right? Again, if you see against this 2600, I am making a payment of 3150, which is a difference of 550. That means I am making a finance cost of 550. If you see the total of this interest cost, this is 51550. For this interest cost, I will be passing an entry of interest expense debit to lease liability. I will increase the lease liability. For this 450, I am making direct payment to the lessor. So I will credit my bank account 450 and debit my lease liability, because my lease liability will come down by this 450 amount. So at the end of 1 year, if you see, the ROU will be this 2229, and the closing lease liability is 2281. Is given over here. Now current non-current would be this minus this, my current amount, rest is non-current, right? Or whatever lease liability in the next year, that is 1946, it is my non-current amount, rest is current. Any doubt in this example? Okay. So it says subsequent measurement of ROU is at cost which we have calculated. In our case, 2600. Amortization, we have charged 371. Impairment, there is no impairment. So WDV will be 2229, right? This is how we calculate the closing balance. If lessee is reasonably certain not to obtain ownership, ROE will be depreciated over the lease term or the useful life, whichever is lower. Let's say in this case, lease period is 7 years, but the useful life was, let's say, 6 years. Then we need to amortize or depreciate these lease asset over a useful life of 6 years. If lessee is reasonably certain to obtain the ownership or to purchase the asset, then we need to also consider 6 years and not 7 years. Right? ROU is subsequently measured using the cost model. However, we can also opt for the revaluation model if the company is following the revaluation model and it falls within that particular class of asset. Then remeasurement of lease liability. The lease liability can be remeasured in the following scenarios, where the amount which is expected to be paid under the residual value guarantee changes. Let's say in our example it was 400, but now we are expected to pay only 200. So in that case, we need to reassess the lease liability. Or the future lease payment changes due to change in the index or rate, or variability of lease payment has resolved so that they become in substance fixed payment, or the scope has changed, or the lease term has changed. So in all these cases, we need to uh, remeasure the lease liability. So in first three cases, we need to use the unchanged discount rate. In the cases of amount expected to where the amount expected to payable under the residual value guarantee changes, or let's say the future lease payments due to change in the index or rate to determine the lease payment, or the variability has been resolved. In these cases, we need to use the unchanged discount rate. In these two cases, where the lease term changes due to change in non-cancelable period, or there is an exercise of purchase option, we need to use the revised discount rate. So a case study where we need to remeasure our lease liability, and accordingly the impact will be on the ROU asset only. It says A enters into a 8-year lease for office space. Lease rent for the first 2 years is 30,000 per annum, payable at the beginning of each year. After 2 years, the rental will be reassessed using a retail price index. So retail price index, that means it's a variable lease payment, because we will consider this as a variable lease payment because this is based on the index. Uh, at present, the index is 126. Incremental borrowing cost is 5%. So on day one, what we will do is we will discount, or we will calculate the present value of all the minimum lease payments, right? That is 30,000 fixed for 2 years, and after that we need to apply the index, right? So we applied the index for 7 years, and it got 1,73,580. ROU asset, it is summation of two, because for first 2 years we have paid the 30,000, right, which is paid in cash. So we will not include this as part of lease liability, because lease liability is calculated for the outstanding lease payment. Now, when we have made these payments of 2,000, 30,000, so we do not have any outstanding lease payment with respect to this 30,000. So we'll discount the lease liability with respect to remaining period, and accordingly ROU asset is there. Assume after 2 years the lease liability is coming to 159,872 and ROU is 152,685. Now, before we make the second payment, the third payment, the lease rental is adjusted to, let's say, 32,000, because the CPI index has changed. So in this case, I will again recalculate my lease liability, which comes to 170,528. How? So 32,000 for let's say third year, and remaining 4 years I will calculate the again the annuity factor into 32,000, right? Now my lease liability is coming 159,872, and I need to have the lease liability as 170,528, right? So my lease liability has increased by 10,656. The accounting entry which I will pass is, I will increase my lease liability and I will increase my ROU asset with the same amount. The remaining lease liability, or sorry, remaining ROU asset will be depreciated over a period of remaining 6 years, right? Because we have entered into a lease for office space of 8 years. 2 years has passed, and from third years this change has come, right? So we have remaining useful life or remaining lease term of 6 years, and on that basis, this 152,685 plus 10,000 will be my revised ROU balance, and that will be depreciated over the remaining six years. So that was the case of reassessment of lease in certain scenarios where, let's say, my lease rent was changing, the CPI index was changing, or any variability in the lease payment was resolved, that has become in substance fixed payments, right? Now there's a case of lease modification where either the scope is increasing or decreasing, or there could be any other modifications as well. Like, it says a lease modification is a change in the scope of lease or the consideration that was not part of the original terms and conditions, like we are adding or terminating the right to use of one or more underlying assets. Initially we had taken, let's say, 5 machines, now we are entering into one additional machines we are taking, right? Or initially we had taken, let's say, 5,000 square feet of area on lease, now we have increased it to, let's say, 7,000, or we have decreased it to 2,500. So all these falls within the lease modifications. Now how we need to do the lease modifications depend upon each of the classifications. So there's a diagram which depicts if there's an increase in scope of lease. Let's say we have taken 5 equipments on lease, and now we are taking one additional equipment on lease. So, if we are negotiating that particular sixth equipment on a standalone price, then we will enter into a separate lease agreement. If that sixth equipment is not at a standalone price, then we need to remeasure the existing lease liability, like we have done in the previous example, right? All other modifications apart from the, so if there's a decrease in the scope, let's say we have taken 10,000 square feet of of space on our rent, and we have decreased it to the 7,500. So in this case, we need to remeasure our lease liability, and we need to remeasure our ROU asset, and there will be gain or loss in the profit and loss account, because I will be reassessing our lease liability, which will be lower than the lease liability which is appearing in the balance sheet. All other modifications, again, we need to remeasure the lease liability and adjust ROU asset. Like the original lease is a company enters into a 10-year lease for 5,000 square meters of office space. Lease payments are payable 50,000 at the end of each year. So again, the lessee incremental borrowing rate is given, which is 6%, depreciation over a 10 years. So we are considering the years of lease as the depreciation period as well. So let's say after the 5 years, the lease liability is coming as 210,618 and ROU is coming as 184,002. Now there is a modification at the start of the 6th year, which says the lesser amend the lease to reduce the space to only 2,500 square meters. So you can see there is a decrease in scope by exactly 50%. We had taken this space for 5,000 square meters. Now we have reduced it to 2,500 square meters. The lease rentals should have been 25,000, because for 5,000 square meters it was 50,000. Now when the lease scope has changed to 50%, but lease rentals are not changing exactly in line with the decrease in scope, right? So what we need to do is the lease liability and ROU are reduced by 50%. So what we will do is 210,618 divided by 2, and again ROU divided by 2. P&L will be, so we have a income, we have a gain of 13,308. So lessee will remeasure the lease liability again. This was the first part when we have decreased the lease liability and ROU asset. Now second is reassessment, because our rentals are also changing. If my rentals were 25,000 instead of 30,000, I will not be doing this second calculation. But since my lease rental is also changing, I need to reassess, right? The difference in the new liability, 126 minus 105. So what effectively I have done is I have reassessed the lease liability for 30,000 for a 5 years period at the rate of 6%. I got 126,370, whereas my lease liability was coming 105,309, right? So effectively 21,000, my lease liability will increase and my ROU asset will also increase, right? So any doubt so far in any of the concept? Hello?
Yes, sir.
Any point or anything to be discussed till now?
Members may raise your query. Kindly, if you have any doubt, kindly raise your queries.
Okay, so we can
So
move ahead with the
we don't think there are
yes.
any queries now.
Okay, so we can move ahead with the lesser accounting. So lesser accounting is based on the concept of Ind AS 17 only. So there's a classification from the perspective of lesser into finance lease and the operating lease. For finance lease, we have these 5 conditions, primary 5 conditions: whether the ownership is transferred at the end of the lease, whether there is any purchase option with the lessee, whether lease is for the majority of the economic life, whether minimum lease payments are more or less similar, substantially similar to the fair value of the asset, whether the asset is of the specialized nature. Apart from this, there are three. Yeah.
Nilesh, in
Yeah.
order to encourage participation, you can ask the questions and ask the participant to write in the chat box the answer.
Sure.
So that will
Sure,
encourage participation. Okay.
Sure, sir. So apart from these five main conditions, there are 3 general conditions, like gain or loss from the fluctuations in the fair value of the residual fall to the lessee or not, whether lessee has the ability to continue the lease for secondary period at the same rent or not, which may be less than the market value, whether lessee can cancel the lease and lessor's losses are borne by lessee. So these all conditions signify like lessee is the actual owner. So if these conditions are being met for any of the particular lease arrangements, so these were regarded as the finance lease. Otherwise, all the leases are operating leases. So it says lease classification test is essentially unchanged from Ind AS 17. We have 5 indicators plus three additional indicators. Lesser classifies the lease either as finance lease or operating lease, right? The less transfer all the risk and reward regarding ownership to the lessee, uh, then it is a finance lease. Otherwise, it's a operating lease. So there's an example to understand how this works. So in case of operating lease, the asset will be decapitalized by the derecognized by the lessor, and he will be recognizing only the rental income in its books, right? And in case of finance lease, he will be sorry. In case of operating leases, he will be charging depreciation, and he will be recognizing the interest income. In case of finance lease, he will be derecognizing the asset, and he will recognize only the rental income. Entity A transferred machinery on a lease for a period of 3 years, and the useful life was 4 years. So as we can see, the lease period is more or less same to the useful life. So it signifies it's a finance lease. The fair value of asset at the date of contract inception is 1 lakh, and the present value of minimum lease payment is 90,000. So again, present value of minimum lease payment 90,000 is not exactly, more or less same to the fair value of the asset. This again signifies it's a case of finance lease, because effectively all of the assets value will be consumed by the lessee only. In the first case also, all of the useful life will be consumed by the lessee only. The minimum lease payments are payable at the year end 37,500 for 3 years. So effectively he will be paying more than 1 lakhs, right? The interest rate implicit in the lease is 10%. Post the lease period, the asset will be transferred to lessee. So it also says the ownership will be transferred to the lessee, right? So it's a clear-cut case of the finance lease. So present value of minimum lease payments amounts to more than 90% of the fair value of asset. Also, the ownership will be transferred to the lessee by the end of the lease term. Hence, the lease shall be classified as finance lease. On the date of commencement of the lease term, the asset would be de-recognized, and lease receivable would be recorded at the present value of minimum lease payment at the date of inception. So since it is a finance lease, that means the lessor has given this machinery on a finance lease to the lessee, right? The actual owner will be regarded as the lessee. So lessor will derecognize this asset from its books. He will not charge depreciation. What he will do is he will recognize finance lease receivable in its books for with the amount of present value of all the lease payments. So he will be getting 37,500 in 3 installments, year 1, year 2, year 3. So he will be calculating the present value of this amount, these 3 payments at the rate of 10%, and let's say that comes to 95,000. So he will book, or he will recognize finance lease receivable in its books of account, and for 3 years he will book the interest income like this. So let's do here. Let's suppose 1,12,500. Let's say the present value comes to 98,000. So he will do finance lease receivable for 98,000, and for year 1, year 2, year 3 he will book interest income. Let's say here 10%, then and remaining over here. Right. Or let's say uh, something like this. So this will be increasing 2390, right? So this will effectively wrong. I have not done the actual working, but what I want to signify is what they will be recognizing finance lease receivable. Then second year there will be an income of 10%. Then year two, then year three. Exactly opposite of this working, right? Here there will be a deduction of 37,500 as well. So at the year end, this amount will become zero. If we add all these, this will become zero, because at the year end, at each year, there will be deduction of this amount as well, right? So when we combine all these and do the actual calculation, at the year end, third year, the amount will be zero. But at each year, he will be getting 37,500 as an lease rent and the interest income on the finance lease receivable. So when we will discount this on a 10% rate, this amount may be 98,000, or let's say 90,000, or whatever amount will come. And by charging interest and by reducing with the installment amount, this will become zero at the year end. So it says again the second example for finance lease. It says ABC Limited entered into a finance lease on 1st July. The terms of the lease were 6 payments of 200 payable annually in arrears. That means we are paying 200 at the year end for 6 years. The cash price of the asset is 870, right? So what we are doing is we are making payments of 1200. Cash price is this. So we are making a profit of 330. This 330 will be paid in 6 installment in the form of interest income, right? So we will book lease receivable for this 870, right? And we will charge depreciation at the rate of 10%, and we will reduce by the rental which we will be receiving. If you see at the end of 6 years, the amount will be zero. This lease receivable is become zero, because against the 1200 we have received the interest income of 330. If you see, the difference was 330. Like this working will be done on an actual basis. This is the comparison chart for operating leases and finance lease. In the case of balance sheet, finance lease, we will show de-recognizing the underlying asset from the non-current assets. We will recognize finance lease receivable. In operating, there is continue. We will continue to capitalize or continue to show the underlying asset under non-current assets. If we have incurred any additional direct cost, or let's say there are any site restoration cost to be incurred at the at the end of lease period, then that will be included in the cost of that particular asset. In the profit and loss account, if we talk about finance lease, we will be having the interest income, right? Or let's say finance income. In the case of operating leases, we will recognize the lease income, that is lease rent, which will be receiving from the lessees, plus will be showing the depreciation expense over the useful life of that particular asset. So impact on the balance sheet: companies with operating leases will appear to be more asset rich, right? Because there will be more asset on the balance sheet, but again there will be debts on the liability side. Profit and loss account: lease expense is front loaded when cash rentals are constant. If you see, these are the cash rentals. These will be constant over the years, but total lease expense will be front loaded. But if you see, my depreciation and expense are depreciation is constant, my lease cash rental is constant, but interest in the initial years is high. Why? If you see here, in the initial year my interest is 131 105, because as and when I am making payment or lease rental payments, my lease liability will keeps on decreasing, and accordingly my interest expense will decrease. However, my depreciation will remain constant, and in the case of lessor, the cash rental payments will become constant. Now the disclosure requirements, it says in the case of financial position, or let's say balance sheet, we need to show what are the additions to the right of use asset every year. That means if we are entering into the new contracts, then the ROU asset with respect to that particular contracts, or if we have changed the scope, or we have reassessed the lease liability due to the conditions given in the standard, then we need to make the comparable adjustment in the ROU asset as well. We need to show the year-end amount of carrying amount of ROU asset, amount of lease liabilities, and the maturity amount of lease liabilities. In the balance sheet, in the profit and loss account, we need to show depreciation expense. We need to show the interest expense. We need to show if we have opted for the short-term exemption and low value asset exemption, then we need to show these two amounts separately. And any gain or loss due to reassessment of lease liability or change modification in the lease, then we need to show that also separately. In the cash flow statement, we need to show cash outflow of the leases. With respect to lessor, we need to disclose the reconciliation between gross investment in the lease at the end of the reporting period, and we need to show the present value of minimum lease payment for less than 1 year, less than 5 years, and more than 5 years. Any unearned finance income, unguaranteed residual values. For operating value leases, we need to show minimum lease payment up to 1 year, then up to 5 years, and then more than 5 years. General disclosures, if there are any rent which is contingent or which will be received, but the conditions are contingent due to any of the conditions to be fulfilled by the lessor, then these has to be shown under the contingent asset. We will not be recognizing these contingent rents, right? A general disclosure description regarding the lessor's leasing arrangements, where the lessor has given its assets on a material arrangements, like most of the assets or all the assets are given on a long term basis, then that has to be disclosed in the balance sheet. Why all the assets are not or are de-recognized during the year, that has to be disclosed. So that was all from this leasing standard. I'm happy to answer your queries if there are any queries with respect to Ind AS 116. We start with the Ind AS 12.
Yes, sir, please. Please start,
Okay.
sir.
So is my screen visible?
Yes, now it is
स्क्रीन विजिबल
visible.
है, आपकी फोटो नहीं दिख रही, लोग आपकी फोटो देखने के लिए लालायित हैं, स्क्रीन तो दिख रही है।
Income taxes India is 12. Yes, it is
आ
visible.
गई सर, फोटो भी आ गई होगी सर।
ओके,
आ गई। हाँ जी, आ गई।
Okay. So the second topic for the day is Ind AS 12, that is income taxes, and we will be interesting some important concept regarding deferred tax asset, deferred tax liabilities, when to recognize, what is the approach for calculating deferred taxes, and what is the accounting treatment in case of business combinations, what are the exemptions from recognizing deferred tax asset or liability, right? And what are the conditions where deferred tax asset may not be recognized by the loss-making companies, and the general disclosure requirements. So, as at the outset, the Ind AS 12 follows the balance sheet approach of calculating deferred tax asset or liability.
कोई होगा ये जो सेल में 38 का मिल रहा 42 में मिल रहा था सेल में 38 का नहीं मिल रहा है अब तो 55 का हो गया
There are two type of taxes which we need to account for while we prepare the financial statements. One is current tax, one is deferred tax. Current tax are the amount which are payable to or refundable in respect of the profit or loss of the company for a period, or I would say taxable profit or loss. Deferred tax, on the contrary, are the future tax consequences, which the company will be paying or recovering with respect to its transaction as and when the temporary differences are resolved. Right now, India says balance sheet approach, and what is balance sheet approach? It says the amount appearing in the financial statements are compared with their tax basis. Any difference is regarded as the temporary difference, and on these temporary difference we will be recognizing the deferred tax asset or liability. Whereas Indian GAAP used to say or is still saying for the companies which are following Indian GAAP, any profit appearing in the profit and loss account of a company is compared with the profits as per the income tax computation, and any difference is considered as the timing differences. Usually the timing differences were basically the 43B, where we were making statutory payments in the next years, right? And based on these, any provision were disallowed in the tax return, right? And all. So we were recognizing the timing difference based on while comparing the profits of the financial statement and the income tax return. Whereas India says we need to compare the accounting base for each and every caption in the balance sheet vis-a-vis the tax return, right? For example, trade receivable. If I have 100 rupees trade receivable, I need to compare it with the tax base of trade receivable. What does that mean? Whether I will be allowed a deduction of 100 rupees as the trade receivable in the tax return, or there may be certain if and buts from the taxation authority, or let's say taxation authority may say your trade receivable are not 100 but 120, because there is some income which is not recorded in the financial statement, but tax return or tax authorities may say this is also your income, or vis a vis. There may be provision which is allowed in the financial statement, but income tax return may not allow the provision. Based on that also, my trade receivable amount may not match in the financial statement and with its tax base. So any difference will be considered as the temporary difference, and based on that temporary difference we need to create the deferred tax asset or liability. Now, what are temporary difference? These are the difference between carrying amount of an asset or liability in the statement of financial position and its tax basis. Like PF liability, again statutory reduce is the realistic example. In the financial statement, I can my amount will be let's say 100 rupees, but in the tax return I will get this deduction as and when I pay to the statutory authority, which is effectively after 31st March for the month of March. So there arise a difference which is considered as the temporary difference, right? So on this temporary difference, we need to apply the tax rate or the relevant tax rate, and by applying that relevant tax rate to the temporary differences, we will arrive at the figure of deferred tax asset or liability. Sorry. Now, these temporary difference could be either taxable or deductible. By taxable means I need to pay tax as and when the temporary these differences get resolved, or these may be deductible. That means against the future taxable profit I will get the deduction. So when these are taxable, or I will have taxable future income, then I need to create deferred tax liability, because in the case of income I have liability. In case of deductible temporary difference, that means they will decrease my profit, and I need to create the deferred tax asset. So it says in case of taxable differences I will have deferred tax liability. In case of deductible differences I will have deferred tax asset. Now, what are tax bases? The amount that will be deductible for tax purpose against any taxable future economic benefit, that is against taxable profit, that will flow to the entity when it recovers the book base. That is my tax base. So simply put, this means for any uh, uh, any part which will reduce my taxable profit is the taxable base for any particular asset, right? So that means tax base is equal to which are deductible while we prepare our computation of income, or let's say our income tax return, right? Items which are not taxable, there will not be any temporary difference, right? Because like the what I would say, any dividend income, right? A dividend income is exempt in case of tax return, right? So there will not be any difference for the perspective of deferred tax, right? Tax base of liability means the asset, the book base less anything which will be reduced from that tax base. That means if we have received any revenue in advance, right, the tax base will be revenue that will be received in advance, and any amount which will be deductible from that revenue in advance. So let's take an example. I have booked an revenue of 100 rupees, but I am anticipating that 10 rupees will not be received in future, right? So my tax return will show only 90 rupees. So that means tax base, sorry, a book base of 90 less any deduction. So deduction is that 10 rupees which will not be collected, because I will not be paying any tax on that 10 rupees, right? As per the income tax return. But under book base, I need to pay tax on the 100 rupees, right? Because I have booked the revenue of 100 rupees. So that's a difference of 10 rupees, which is my temporary difference. This is the calculation of tax base in the case of liability. Again, in the case of asset, there could be an example of provisions, ECL provision, expected credit loss provision in the case of trade receivables, right? Now this is the these are the steps which these are the steps to calculate the deferred tax. First of all, we need to calculate the tax base for each asset and liability. Why we are not required to calculate the book base? Because in any way we have the financial statements, and the amount appearing in the financial statements are the book bases, right? Second is we need to calculate temporary difference. How we calculate temporary difference? Book base minus the tax base. Resultant is my temporary difference. Then we need to see whether that is taxable or deductible, because for taxable temporary differences we will recognize deferred tax liability. For deductible temporary difference we will recognize deferred tax asset, right? Then we need to identify which temporary difference give rise to deferred tax using the recognition criteria and exemptions. So all the temporary difference are not required to be recognized for or considered for the deferred tax asset or deferred tax liability, because we have certain exemptions on the initial recognition, right? Then we need to the fourth step is to calculate the deferred tax asset or liability considering the appropriate tax rate. Now, what is the appropriate tax rate? Is the tax which is expected to be applied in future. Tax rate expected to apply to the future period when the deferred tax asset or liability is realized or settled. Tax rate which are enacted or substantially enacted at the balance sheet date, right? Then we need to recognize the net movement. Net movement means whatever deferred tax asset or liability we have recognized till last year's balance sheet, and what amount we have been recognizing in this year. Difference between the two is recognized in the profit and loss account. So that we will say the net movement. So this is the snapshot. Carrying amount minus tax base is equal to temporary difference. Temporary difference into tax rate is equal to deferred tax asset or liability. We need to also recognize deferred tax asset in the case of unused tax losses, right? If there are carry forward losses, then we need to consider recognizing the deferred tax asset. If this is virtually certain, or there is a reasonable assurance like the future taxable profit will be there against which the unused tax losses or these credits will be utilized. If there is no virtual certainty of probable future taxable profit, then we should not recognize the deferred tax asset, because it ultimately tantamounts to inflating the balance sheet if we are wrongly recognizing the deferred tax asset. So these are the initial recognition, or I would say exemption from recognition of deferred tax asset or liability, right? If we are recognizing any asset or liability initially on initial recognition, let's say I have made a or I have purchased a plant and machinery. I am booking an entry of, let's say, plant and machinery debit to vendors. So I am not required to calculate and recognize deferred tax asset on the initial recognition, right? Initial recognition of goodwill, that means in the business combination, if I am recognizing any goodwill, I am not required to calculate the deferred tax asset. However, there is no sorry if I am calculating if I am calculating goodwill in case of business combination, I am required to calculate deferred tax asset and recognize. However, if that goodwill comes to be negative, that means there is a capital reserve which ideally is not there. But in some cases, if I am purchasing loss-making company, I could have the synergy benefit and I could have the negative goodwill or the capital reserve. In that case, I am not required to recognize deferred tax liability. There is an exception. Again, if I am making any investment in subsidiary, branch, associate, or joint arrangement, I am not required to recognize deferred tax asset or liability. Probability of recovery, that means there is a company which is incurring losses since past few many years, then there is an exception for that company to not recognize deferred tax asset if the net position comes out to be deferred tax asset. However, if the net position is deferred tax liability, then that company has to recognize that deferred tax liability, right? Net position means we will calculate deferred tax asset for all the applicable cases. We will calculate deferred tax liability for all the applicable cases. And on a net basis, we will see whether the net position is deferred tax asset or deferred tax liability. So initial recognition exemption, it says initial recognition exception applies for both deferred tax asset and liability, right? However, there is one exception to this exception also. If I am recognizing any asset or liability under a business combination, then I need to recognize deferred tax asset and liability, right? So if you see initial recognition of asset liability, yes. Whether these asset or liability arise in a business combination, if yes, then we need to recognize these asset, deferred tax asset or liability, right? If these asset or liability are in a general business, like I am purchasing these or I am entering into general business transaction apart from the business combination, then this exception is applicable, right? So these are the condition. These are some of the examples to understand in which scenarios we are required to calculate and recognize deferred taxes. So purchase of plant and equipment. Initial recognition of plant and equipment, we are not required, right? Must arise on initial recognition of asset or liability, yes. Not arise in business combination. This is not a business combination. Not impact accounting profit. Purchase of plant and equipment does not impact accounting profit and taxable profit, right? So here it is not applicable. And also this is a clear-cut exception, sorry. Initial recognition of asset liability, right? Annual accrued annual leave. Carrying amount is 40,000, tax base is nil, right? So whether it arises or initial recognition of asset or liability, no. Arises on business combination, no. So this test is passed. Whether affects accounting profit, yes. So this C condition is not satisfied. Whether affect taxable profit, no. So this condition is also satisfied. Since one condition is not satisfied, in that case we need to prepare the we need to recognize the deferred tax, right? Again, investment property 5 lakh 450. Whether initial recognition, yes. Arises business combination, no. Whether affect accounting profit, no. Whether affect taxable profit, no. So all the four conditions are met, so we are not required to recognize profit. And like this for investment property, the only change in both these condition is the last one arises as a business combination. So this second condition has not met because this is arising in a business combination. This has not met, and accordingly we need to recognize the deferred tax on this temporary difference. This is a temporary difference of 50,000, right? So any queries so far? Anything to be discussed? Okay. Deferred tax arising in a business combination. So first of all, we need to see the carrying amount of investment or whatever that is as per the fair value. That means whatever assets and liabilities we have acquired, we need to do the fair valuation, and that needs to be compared with the tax base. Tax base means the purchase consideration which we have given. Any resultant difference will be temporary difference, and on this difference we need to calculate the deferred tax asset or liability. So whatever amount we will be paying, we will allocate to the assets and liabilities, and these will be at the fair value. We will reduce the tax base of all these assets and liabilities. Resultant temporary difference will be multiplied by the deferred tax asset or liability, and we will be getting the deferred tax asset or liability as the resultant from this type of working, right? Now whatever consideration we have paid, we will also reduce the deferred tax asset or liability to arrive at the goodwill figure, right? So let's say we have paid the 100 rupees, right? Now, see, right, 3000।
जी ये बड़ा नहीं हो सकता, ज्यादा छोटा छोटा नजर आ रहा है।
हाँ जी सर, बड़ा हो जाएगा।
इसका फॉन्ट साइज बड़ा कर दीजिए थोड़ा। हाँ
ठीक है सर।
हाँ, आप ठीक है जी। हाँ जी
ठीक है, और लायबिलिटी लेट्स से 10,000, liability B let's say 5,000, right? Now let's say what we used to do is we need to just is coming as 70,000 against the 1 lakh, right? So what we were doing is 1 lakh minus 70,000 is my goodwill, but what we will do is for calculating any goodwill we will also deduct DTA detail. Let's say deferred tax asset or liability on this 70,000 comes to 10,500, right? So my goodwill will be this minus this minus this 19,500. This is what this picture shows. So consideration transferred, right, will be allocated to assets and liabilities, right? Whatever DTA or DTL, that means deferred tax asset or liability, will come, that will be added here, and resultant will be goodwill. So these total will be compared with the consideration received. These assets and liabilities will be at fair value, right? And resultant will be goodwill. This is how here is called calculated. There's a company which acquires 100% of the common shares, which are equity shares of company B, for let's say 20 lakhs. Fair value of the identifiable net assets is 18 lakhs, and the carrying amount and the tax base of net assets is 10 lakh, right? So aggregate fair value, or let's say what I will say is the carrying value as per the financial statement is 18 lakhs. Tax base is 10 lakhs. So temporary difference has come to 800, right, or 8 lakhs. So deferred tax liability will be 2,40,000. Now how we calculate goodwill is fair value acquired. So if we do here 2,000 less 1,800 is the fair value, and less 240 is my deferred tax, right? So my goodwill will be 440, right? You see here, if we were not doing this deferred tax adjustment, then my goodwill was 200. So this deferred tax, again, deferred tax is a loss only, right? So this has shown into this goodwill calculation. Under Indian GAAP, we were not doing this adjustment, right? So this is a change in case of business combination. So recoverability of deferred tax asset. It says if a company needs to recognize deferred tax asset, right? Then we need to see the probable recognition criteria, right? It said it should be probable that future taxable profit are there again.
Nilesh
Yeah,
ji, just one question
yes, sir.
here. कि whether
Yes.
in case of business combination, we can trace it earlier also. We can recalculate the deferred tax asset or liability in case it is beneficial for us.
When, at what time, sir?
Actually, suppose we entered into a business combination, say 10 years back, and we want to
Okay.
recalculate from there itself, so that
नहीं sir,
it
वो
is
that नहीं so you want to this do this goodwill reassessment, right?
not goodwill reassessment. We want to recalculate the deferred tax asset or liability.
हाँ, deferred
Or if we had
नहीं
not
so
recognized the deferred tax asset or liability, we want to
so
do it
that
now.
if you have not recognized, so that will be the case of Indian GAAP, right? If you are saying 10 years
Yes,
back,
yes, yes, yes,
then
yes.
this is not allowed. This is not allowed
But they
because
say
that
in case of
transaction
business
has happened.
combination, you can do it.
But no, business combination which will be effective under Ind AS, right? What you have done under Indian GAAP, you have done because now the transition date has also passed, right? So let's say the company transition to Ind
No,
AS on
suppose
one.
suppose our
Uh,
company was not coming under ADS till now. Now we have
okay,
got it listed. Now it has come under this.
no, that's what I am saying. If the company has not prepared or not followed Ind AS till date, and the company will be preparing first India's financial statement, then they can do so on the transition date, right?
Yes,
So
yes,
what
yes. That is what I
effectively,
am asking.
yes, yeah, on transition date you can do. So what you will say, you will not be following any of the exception or exemption offered by Ind AS 101 for
Yes,
first
yes,
time
yes,
adopter, and you will apply
yes,
Ind AS 103 from the past, right? So what
yes,
you will do, you will do accounting of the all the business combination as per the Ind
yes.
AS 103, and this accounting
Hmm.
can be done. But if
Okay.
any company has presented its first India's financial statement, then they cannot do because they
Yes,
they
yes.
have applied the
Ah,
India's 103 already,
yes, yes. It's
right,
okay.
sir?
Thank you.
So recognition criteria says it should be probable that there will be sufficient future taxable profit against which these deductible temporary differences and unused tax losses will be set off, right? If there is no probability to have these future profits, then as a concept of prudence, the deferred tax asset should not be recorded in the books of accounts, because otherwise what will happen, we will just inflating our balance sheet, right? We know we will not be having any future taxable profit to adjust or set off this deferred tax asset, but again we are booking, so that should not happen. So assessment of taxable profit, whether there will be the future taxable profit or not. So there are two pros and cons. The indicators which show that there will be future taxable profit means there are long-term contracts where we have the higher profit margin, or we will be acquiring profit-making entities, right? Or we will be appreciating the asset value by let's say using the advanced technology, or we can do the revaluations, right? Or let's say company has a strong or past history of earning taxable profits, right? Whereas the scenarios or indicators which show or which weakens the case for recognizing deferred tax asset is the recent losses, right? Businesses start up new in the industry, right? Or we have the history of expired tax losses without any adjustment, right? Or there are quality problems or quality claims being lost by the major customers. So these are the indicators which shows that deferred tax asset should not be recognized. However, these are the indicators which can make our case strong in case of probability to recognize the deferred tax asset. So as a general rule, deferred tax are generally recognized in the profit or loss account. But if the item is recognized, let's say in other comprehensive income like revaluation reserve or when we currency translation, right? Then we can recognize that we need to recognize the related deferred tax asset or liability in the OCI, right? If there are any transaction which have happened in the equity to equity, right? Like we are preparing the third balance sheet in the case of transition to Ind AS, or let's say in the case of error, we are preparing the third balance sheet. Then if we are debiting or crediting any amount to the retained earning, then any related deferred tax should also be set off from the opening retained earning only, right? Now presentation and disclosure requirements. The standard says DTA and DTL as well as current tax assets and liabilities should be presented separately from other assets and liabilities. We are not required to classify it within current assets and liabilities. Deferred tax assets and liabilities are always non-current. These are not current assets and liabilities. We need to separately disclose the following, which are like deductible temporary difference, unused tax losses, unused tax credit for which we have not recognized the deferred tax asset because there were not probable, or it was not probable the company will have sufficient future taxable profit. Again, we need to also show the investment in branches, joint venture, associate, subsidiaries where we have not recognized the deferred tax asset as per the exception offered by the Ind AS 12 in the scope or the recognition. uh, Income tax consequence of the dividend to shareholder that were proposed or declared before the financial statement were authorized for issue, right? But again, the liability is not recognized because we need to create liability when these are approved by the shareholders. So we need to disclose that amount as well. We need to also give the numerical reconciliation with the accounting profit and the effective tax reconciliation, if we have made the tax provision at the 30%, but effectively in the computation, let's say my effective tax rate comes to 29.8 or let's say 32.3, whatever, based on the different deductions and different exemptions, then we need to provide the reconciliation between these two profits as well. We need to also disclose any contingency related to any tax positions, right? Or if we have been in any litigation, then we need to also disclose this as part of contingent liabilities. So this was all from Ind AS 12. If there are anything to be discussed, I'm happy to discuss.
Members, you can ask your questions.
I know why it is asking like this.
So Nilesh ji, we think there are no more questions. So any other ideas you would like to cover besides these two?
No, I think these
Or
were the only scheduled.
what you can do is you can suggest some practical difficulties which can be faced by someone who is doing this.
So in case of if we talk about Ind AS 16 or sorry Ind AS 116, the major problem which comes out is the assessment of lease term, right? Which I said because under Ind AS 17 or the practice was just to search for how many years the lease term is entered, and we end up calculating the lease liability based on that term. But the lease term has to be calculated very carefully by reading all the clauses with respect to renewal option, any extension option, termination option. Because if I talk about myself, I was not reading all these clauses before this Ind AS 116, but these clauses are very important from that perspective, because lease term is dependent on this, plus my lease payments are dependent on this. because until unless I know what will be the termination liability or payment, how will I correctly calculate my lease payments, right? If we talk about ROU asset, then we need to also figure out whether any lease incentives are being given by lease lesser, right? So there are so if we talk about India 17, we were just reading what is the lease amount, what are the lease term, right? I don't think we were reading the full lease agreement, because the requirement was just to straight line the lease payment over a period of lease term, right? So effectively, we were just seeing what are the lease payments which I am incurring year on year, and what are the what is the lease period, and I was just dividing and calculating the straight lining amount, right? So that is one thing where most of the people commit mistake, right? Second is the low value assets and the short term exemptions, right? We need to consider, we need to carefully take this exemption, because one is on a lease by lease basis, second is on a class basis, right? So there is a chance of error which one can commit if we are opting for these optional exemptions, right? And third is while we do the accounting for the change in the scope, or when the lease there's a case of lease modifications, right? So there are two things which we need to do. One is, first of all, we need to reduce our lease assets, sorry, lease liability and ROU assets with the percentage of decrease in scope, right? Second is, if my lease rent is not being changed with the same proportion to the change in scope, then we need to also reassess our lease liability, right? Because there's a chance of not doing the complete calculation. One may end up only decreasing the lease liability, and may skip the second part of lease recalculation or lease liability recalculation. These are the major calculation mistakes I think one can do, or are generally done by the teams. Apart from this, the appropriate classification, right? Whether the lease agreements are within this scope or not, that is very important, considering the definitions of leases, identified asset, and the right to direct the use. Although these are very subjective, but if we need to correctly classify whether the lease agreement falls under India's 116 or not, we need to correctly we need to read the complete lease agreement and correctly classify this, whether this is within this purview or not. These
Okay.
are the things which I can say for this.
Regarding right to use assets, hope you
So
have already covered.
right to use asset is again the contra entry for lease liability only, right?
Yes,
So I
yes.
don't think there will be any chance of making any mistake if we have correctly classified or calculated the lease liability.
Okay.
Yeah.
And there are contracts which contain lease component and one or more additional or non-lease component then in such a
Right.
scenario.
So again, there is a accounting policy choice which is standard give. If there is a non-lease component, then either we can just ignore the non-lease component and directly charge it to profit and loss account, or we can make accounting policy choice like we will not be separating the non-lease component, and we can do the accounting on a consolidated basis. Both are allowed.
Okay. And if the lease terms are varied in between then?
So again, sir, if the lease term changes, then again we need to reassess our lease liability, because the one thing which can change is extension option. Let's say initially we thought ki lessee will opt for the extension option, or let's say purchase option, but after 5 years we reassess the lessee will not be opting the purchase option. Then my lease term will get reduced. Then again we need to reassess our lease liability based on the uh, decreased lease term.
Okay. And this Transfer of Property Act, it also talks of leases, different types of leases like lease for agricultural use, lease for manufacturing use. So
Which
does it
which
have
act,
some
sir?
Transfer of Property Act?
Okay.
Trans- Transfer of Property Act says that you can enter into lease for this specific tenure only, depending upon the purpose for which this lease agreement is
Okay.
given.
Okay. So what is your question on this?
My question is whether we have to take that also into account.
No, 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 no. So these type of lease agreements, what I understood is for any specific purpose, right?
Yes, yes,
But
yes.
India's 116 specifically says the formula for lease term, and we need to calculate lease term as per that formula only. So if we are saying the lease term is only for 10 years, but we need to again see whether there is any non-cancelable period, right? Let's say in
Okay.
that case, the lease cannot be cancelled for 3 years. Then 3 years is
Hmm.
only the lease term. If there are no non-cancelable period, then I will consider the 10 years as the lease period. Depends how the
Okay.
lease other clauses are structured.
Okay. Okay. So for the uh, better understanding of members, can I give one question here to which you can provide
Yeah,
the
yeah,
answer?
yeah, yeah.
So the question is, there are two parties who have entered into a contract for lease of a truck
Okay,
for a period of 5 years.
okay,
Annual lease payment is 10 lakhs
okay.
to be paid at the end of each year.
Each year.
But what they do after 3 years, they modify the contract
Okay,
to increase the scope by including an auto rickshaw in lease contract.
okay,
And lease payment for the remaining 3 years, now it is increased by 5 lakhs. So now it is 15 lakhs instead of 10 lakhs,
okay.
which is commensurate with current market price of an auto rickshaw.
बिल्कुल
So
ठीक
in
है.
accordance with Ind AS 116, what will be the accounting treatment of
So, sir,
said lease
in this
modification?
case, yes, yes. So, in this case, there is an increase in the scope, right? So, what
Yes,
we are doing is we are getting one additional asset on a lease, right? On a standalone
yes,
basis,
yes,
right?
yes,
Because
yes,
it is mentioned my lease rent has increased from 10 lakhs to 15 lakhs, right? So, and I
huh.
have got one more asset, that is a rickshaw
Yes,
in
yes,
return,
auto
right?
rickshaw.
And it is
Yes, yes,
also mentioned like it is on a market rate for the rickshaw,
yes,
right?
yes, yes,
So
yes,
it means that 5 lakhs belongs or depend or signifies the lease rent for the auto rickshaw, right? Because so accordingly
yes,
we will need
definitely.
to consider this lease of auto rickshaw as a separate lease component or a separate lease arrangement, and we need to
Okay,
calculate the lease liability for that 5 lakhs depending on the tenure and calculating its present value. Whatever coming with respect to trucks in my books of account, I will not do any adjustment to that, but I will calculate the lease liability on a considering this a new agreement.
okay.
Yeah, because this is
But
on
if
a
we,
standalone basis.
but if we change the question a little bit,
Yes,
there is a change
yes,
in technology. There is a change in
yes,
truck technology, and they have introduced the new technology in the
correct.
trucks which were given on lease earlier, and they announced the lease payment. Then in what that scenario?
So again, we need. I think if it is changing, like they have changed the truck technology, right?
Yes,
Then I will go back to the agreement and see whether the lessor was having the substantive right to substitute the asset, because it amounts to substituting the asset, right? So if I have given the substantive right to the truck owners to substitute the trucks, so in the first thing I need to assess whether I have correctly classified this as a lease arrangement or not. Second, if
okay,
I say I have correctly classified these as a lease arrangements, then we need to just remeasure our lease liability based on the
okay,
because my lease rentals will also be increasing, right?
okay, okay.
Or there could be third scenario.
Hmm.
I could also consider this because effectively the assets are changing. First, in the first instance, let's say I got the Honda City car. In the
Yes,
second
yes.
instance, you are saying I have replaced and I have got, let's say, Honda City car, but the that automatic model, right? So
Yes, something like that.
yes. So third view could be to discontinue that particular first lease agreement and enter into the new lease agreement. So there could be three possible views on this.
Mhm. Okay, so now we come to this India's 12. Let us have some
Right, sir.
questions on this. So we are talking here in India's 12
Right, sir.
regarding a newly incorporated entity.
Okay.
So its first financial year, it ended on 31st March 2020. I am asking these questions just for the benefit of all the members
Right, sir.
so that
Right,
they
sir.
can understand the implications.
Correct.
So as on the said date, the following temporary differences exist. So they
Okay.
are saying there are some temporary differences. First is taxable temporary differences relating to accelerated depreciation
Right.
of rupees 12,000.
Correct.
But these are expected to reverse equally over 4 years.
Right. So these are
This is
temporary
one.
difference because right.
Yes. And second is deductible temporary differences of 5,000 expected to reverse equally over next 5 years.
Correct.
And it is expected that the company would incur losses for next 6 years.
Right.
Tax rate is 30%.
Right.
The losses can be carried forward to the next years. So calculate the amount
Next,
of deferred tax.
how many next years?
They say they can be carried
Okay,
forward
n number of years.
till they are
N number of
exhausted.
years.
Yes, yes. So
Right.
calculate the
So
amount of deferred tax.
correct. So in this case, the deductible temporary difference will give rise to your deferred tax asset, right? And the
Mhm.
taxable temporary difference will give rise to your deferred tax liability, right? Let's say
Mhm.
on a net position we are getting deferred tax asset. So what
Mhm.
is your maximum amount taxable differences or deductible differences?
Taxable is 12,000 and
And
temporary
deductible is
is
4,000.
deductible is 5,000.
So effectively we will get taxable amount is more. So effectively we will get deferred tax liability, right? So
Mhm.
in this case, we can recognize deferred tax liability because there is no probability condition required for deferred tax liability, right? But in the fifth year, I think there is no taxable differences, only the deductible differences is there on in the
Yes,
fifth year,
yes,
right?
yes,
So in
yes,
that
yes,
case,
yes.
we will be getting only the deferred tax asset, right?
Okay.
And since there is a history of getting the carry forward or
Yes,
unused tax
losses are
losses,
there. Yes.
so
Mhm.
in the fifth year we need to see or we need to apply our judgment whether sufficient taxable profit will be there in future to adjust this deferred tax asset or not. But since company is saying they can meet or not on
Yes,
the losses part.
yes, they can say they can carry forward indefinitely.
No, losses can be carried forward indefinitely, but is company saying anything on the profit part, whether profit will be there in future or not?
No, it is saying it would incur losses for next 6 years.
Correct. So in the fifth year, if we are saying only for 1 year the loss will be there, then I think in the fifth year we can recognize deferred tax asset because in the fifth year we can recognize deferred tax asset because after 1 year we will be getting the profits.
Mhm.
So
Okay,
we need to
thank you,
see
Ji.
this position
Fine.
on a year by year basis.
Yes, yes, yes. Bipin Kakkad ji, any question? So I think there are no more questions. Anyone can unmute himself or herself and can ask the questions. Otherwise, I think Nilesh KHEMKA ji has beautifully covered the entire subject in a very practical manner. So Bhardwaj ji, I think we can conclude here. And Nilesh KHEMKA ji, please share your PPTs with us.
श्योर सर श्योर मैं व्हाट्सएप करता हूँ आपको और भारद्वाज जी को
हाँ जी, हाँ जी, हाँ जी, हाँ जी. तो भारद्वाज जी